Good morning, everyone. Thank you for coming to our very early discussion on creative financing strategies in a tough market environment. I'm excited that we were able to curate such a great mix of talent and different perspectives from investors to pharma, startups, and all along the spectrum of how we view our market and go about getting capital. So thanks for coming. I am Audrey Greenberg, founder of the Center for Breakthrough Medicines, a cell and gene therapy focused CDMO that was acquired by Pharmteco just a year ago. And I would like to start out our panel discussion with Aaron. If you could quickly just introduce yourself, maybe talk about ARCHIMED, what you guys are doing in the market, and how you see things today.
Yeah, sure. Hey, nice to meet you guys. Aaron Fisher. I have been an investor for about 15 years, majority of my career, and spent probably the last half focused in life sciences. Started my career actually at Stevens. Jacob Johnson's in the crowd. He covers the life science tools and diagnostic space from an equity research perspective. I'd encourage you guys to check some of his materials out. But let's see, I joined ARCHIMED just over a year and a half ago to co-lead our life sciences vertical across the globe. I think what's unique about ARCHIMED, well, we've grown extremely rapidly, about $8 billion under management today. A lot of flexibility in how we invest and the size of check that we write, anywhere from 10 million up to $1 billion and everything in between. Gives us a wide range to look at what's going on in the earliest stages of the market as well as in the later stages and fairly complex transactions to simple ones as well. Anything from carve-outs to take privates to change of control to minority investments as well. From the way we're set up, we focus exclusively on healthcare. We focus on investing in healthcare globally. We have a team with about 30 different nationalities under one roof. I think that gives us, as I've learned the hard way being purely American and spent my entire career in the US, gives you a lot of access to companies in different cultures and markets that I think traditionally in the States wouldn't think of exploring. We focus again on different areas of healthcare. We're set up by what we call med-segs. So I spend my time in life sciences, and in the life sciences team, you've got folks like me who have been career investors, complemented by folks who have done bench science work, Ph.D s, M.D s, in different areas of interest, as well as former operators like some of you in the crowd who have built your companies from the ground up, grown them and sold them successfully. And I think that gives us a comprehensive view of how to be supportive partners to companies in the space.
Very interesting. Thank you for that great introduction. And we'll get into I have a lot of questions to ask you. But first, Tracy, you want to provide an introduction about yourself and the company AskBio?
Absolutely. Good morning. Thanks to everyone who got up early or is streaming early this morning. I'm Tracy Dowling. I am the Chief Business Officer at AskBio. AskBio is a gene therapy company that is an end-to-end company moving from platform R&D through the clinic with manufacturing as well. So we really are hoping to provide transformative therapies to patients from the beginning to the end. We were acquired by Bayer in 2020, so coming up on a 4-year anniversary. Prior to joining AskBio, I was at Spark Therapeutics, another gene therapy company in the space.
Fantastic. Thanks so much, Tracy. And you have a unique perspective and background, too, given your technical expertise, let's say, as well as some industry expertise. So excited to get into that. Richard, can you please let us know about yourself and your company and what you're looking at these days?
Sure, thank you. So I'm a Ph.D. neuropharmacologist by training. I've spent over 30 years in some of the larger companies, Roche, 15 years, Shire, down to startups. I've been with uniQure for just over 3 years. They acquired a company that I was the founding CEO of, and I'm now the Chief Business and Scientific Officer at uniQure. Our focus is very similar to Tracy. We're an AAV gene therapy company looking to develop transformative medicines. We recently had the approval of Hemgenix, our product for hemophilia B. Maybe we'll talk a little bit about that during the panel discussion. And we have a pipeline with a focus on more neuroscience, neurological diseases.
Fantastic. Thank you so much. So Aaron, at ARCHIMED, you've made a lot of interesting investments in the cell and gene therapy space, given the platform we're talking about today. Can you talk about a little how you see the market right now, where you see pockets of opportunity, and how you perhaps made the decision to invest in Plasmid Factory? What were some of the key criteria? What was the hypothesis going in? What do you hope to accomplish? How did you structure the investment? Things that the audience might find interesting.
Yeah, sure. So maybe we'll start with the first question. I mean, what we see in the market is probably readily abundant to a lot of folks in the audience here. It's been a pretty chaotic past, I'd call it 4 years, 5 years even. But I think right now it's a buyer's market relative to a seller's market, right? I think even if you look at where public companies are trading, I think what we're seeing is that multiples, enterprise value to revenue or EBITDA, are trading close to 10-year averages, suggesting that the market's starting to normalize, at least market expectations. But look, I think biotech funding, we're seeing rebounding back to 2019 levels. I'd say it's still, things don't seem to be going to the moon anymore, and I think valuation expectations are probably tempered as a result. So, I think for us as an investor, if you believe in the long-term opportunities in the market, which, some of which we can talk about, it's a decent time to be investing. So, that's what we're seeing. I think we're also seeing a lot of damaged businesses right now. I think people are hurting. There's certainly a need for capital. It's not easy out there if you're an entrepreneur or operator. In terms of areas of interest, I mean, we organize by focusing into certain subsectors of particular interest. I think it's no surprise that GLP-1s are a big opportunity. I think obviously, right, there was a big announcement with the deal that's going on with Catalent. I think obviously the rationale behind that is driven by GLP-1s to an extent. We're looking at antibody drug conjugates, the manufacturing and supply chain for bringing those therapeutics to market. We continue to remain optimistic on cell and gene therapy broadly, so we're still spending a lot of time in the tools and services that go around bringing these next-gen therapies to market. And then I'd say those are really kind of the three core segments of highest interest for us right now.
Fantastic. And what about Plasmid Factory?
Yeah, second question. So Plasmid Factory, that investment was made before I joined the firm, but I think, again, probably obvious to most folks in the room, it's a plasmid services, plasmid development business. We were expecting, I think, the investment thesis predicated on gene therapy, right? It's in terms of how it was structured, this was a majority investment. We recapped the business. The founder rolled close to 30% equity and continues to run the business today. So we support him and continue to build that out. But it's, I won't lie to you. I don't think it's been an easy market in gene therapy, as everyone knows. And I think, that business has done okay. But I think it's behind plan from the standpoint of when we entered it.
Yeah, to follow up on that real quickly, you mentioned the founder rolled a lot of the equity in. When you are looking at potential founder-based companies and the founder still involved, how often do you try to lock up the founder, and what criteria do you use to make that decision?
Yeah, so I think, look, I think to us, certainly, we're very flexible in how we partner with businesses. We tend to prefer majority, and look, when investors are asking you for a majority position in your business, the reason behind that is we are pooling capital from a number of different LPs or limited partners, and they expect liquidity at some point. So having a, control, quote unquote, allows you to eventually achieve liquidity at your will. Sometimes, the risk from our standpoint of being stuck in a minority position can be you're stuck behind a group that wants to never achieve liquidity, right? They hold the business until the end of time, and you're stuck from that standpoint. And our business is maximizing returns for our investors. So we back founders a lot of times. We provide flexibility to founders who want to continue running their business and need a partner who's going to continue to fund the growth of that business. And so we actually applaud folks who want to stay with it and continue. Some people want to, sell a majority of their secondary and go sit on a beach somewhere, which is perfectly fine. You've earned that right. But if you want to continue doing it, we are adamant about supporting you with folks. You might need additional experts around the table. You might need additional capital to acquire additional capabilities. You might want to build a facility. So generally speaking, that's when founders come to us to also de-risk their position, right? You've spent a lot of time building your company, and you're looking to, quote unquote, take some chips off the table. So that's generally speaking how we view structuring our investments. There are times where we'll consider minority type investing and also more kind of creative structures like convertible notes. It's certainly not core to what we do, but it's something that we do consider.
Well, you sound like a great partner. So it's good to know we have investors out there that are so founder friendly, let's say.
We try to be.
Yeah. So Tracy, moving over to AskBio and the Bayer acquisition. Everybody's so curious to hear about that landmark transaction and what it meant for the gene therapy space. Can you talk a little bit about that transaction, how it was approached, how it was structured perhaps, and how does it, for those out there in the development space, perhaps secure or risk adjust the pipeline perhaps and help develop therapies and get them to patients more expeditiously?
Sure. So that was a lot of many questions.
I'm good at
there.
that.
Yeah, she's good. So let me take the first part. So again, the deal was a couple of years ago, and it was a significant transaction. Bayer paying up to $4 billion on it, structured in a way with some upfront and some back end milestones. So first, you were asking about the deal structure. And it's really interesting when we think about milestones and earnouts as we're structuring deals on either side of it and how they really apply to the operations. And I think it's very different when you're doing a licensing deal with milestones than an acquisition with milestones, just because you're operating. When you acquire a company, it's then operating, and you really want to make sure that the milestones that the company has agreed to before you've acquired it are the ones that you still want them to pursue once you've acquired it. So that alignment and agreeing to it in advance, especially if the milestones go out for years and years, is a true art to get that right. And you do continue to live with that document for a long time. So I do think in an acquisition, having back-end payments, while it does mitigate some risk on it, also just has to be really carefully thought out and crafted. So the second part was about the portfolio and how really these acquisitions are enabling the portfolio. And to be fair, when you're in a biotech trying to move 6 preclinical programs, 4 preclinical programs through, the people who are in biotechs in this room, it's expensive. It's really hard to do, and to do all of it without some sort of larger partner. And also in terms of the skills that you need to be successful in late stage clinical trials and hopefully to commercialization are often those that you're not building and you can't afford as a standalone company. So, when I look back to my days at Spark, when we got the Luxturna approval, we realized we couldn't do both US and ex-US commercialization and launch on our own. It was too much for a small company, so we partnered with Novartis on the ex-US rights. I think for AskBio, there would have been, if Bayer had not come in with the acquisition at the time it had 6 programs in clinical trials, and it would have had to make, I think, some difficult decisions about prioritization that many people are feeling. So I do think Bear has enabled AskBio to really continue to push forward and to push forward at pace in many of these, which ultimately, which I think you got to, is what we need for these diseases and for patients, to try to keep up the pace on things.
Can you talk a little bit more just about the milestone-based payment arrangements from a business and a legal perspective, and from the perspective of perhaps those in the audience that are looking to enter into some big pharma dollar deals, and what they can either look out for from a risk perspective or seize the opportunity on from a structure perspective?
Yeah. Sure. And so I think I'd like to sort of comment more, because it's easier, on the licensing ones. Because I think we know when you're structuring and Richard, will be good to hear from you on your thoughts on this as well. But when you're starting to structure these license deals, you sort of know where the milestones are going to be. There's, some slight tweaks, but is it, first patient enrolled? Is it first patient dosed in phase 1? Is it a phase 1/2? Is it, how does it roll through? I think what's been interesting about that, though, is the expectations, the timing expectations between what you think you can do as if you're the smaller standalone company versus what the timing expectations from a larger pharma. Because I think things take longer than we think they're going to take. And sometimes you will factor in a 6-month buffer, but it's really, sometimes 12 months. Manufacturing, process development, all of these things take time. So I think the milestones are easier from a licensing perspective because there's only so many and people don't really reinvent the wheel too much. But it's getting the expectations right on when those will hit. And if you're the payer, accounting is always asking, when do we think those are going to hit? And that can just move a lot. I'll also say the sales-based milestones. You're guessing at the very beginning, particularly if it's a preclinical company that you're working with, you're guessing very early on, what are the meaningful sales milestones going to be? And what are the things that could change? Well, we've seen the regulatory environment change. We see pricing change. Honestly, and then as you get further in diseases, you think you know what the prevalence and incidence is, but sometimes it's easier or harder than you think. And again, I think you'll probably be able to speak to this. So I think the risks with these milestones, whether they're clinical or sales-based, is the timing on one, and then what's the right line to set on the sales ones.
Yeah, really good point. I hadn't thought about the sales-based milestones. That's very interesting. So Richard, congratulations on the approval, and thank you so much for being on the panel. uniQure has really been at the forefront of gene therapy, particularly with the breakthrough Hemgenix. The first gene therapy, by the way, for those that don't know, for hemophilia B. How do you approach financing from the perspective of high-cost clinical programs, as Tracy was talking about? And how do you position for potential takeout scenarios?
Thank you. Yes, so many common themes. So uniQure's been in the business for about 25 years. We currently have 4 clinical stage assets, which we are funding, as well as trying to drive an innovation engine in research and manufacturing. That's expensive. And I guess we think of how, if I maybe start, how we have tried to fund that is really considering the cost of capital and the dilution factors. So as a publicly traded company, the simplest way is equity. And we have typically done that on the back of value inflection points, or when there's a strong market and we can raise money and with relatively little dilution, and that hopefully funds the research and development efforts to the next inflection points. That's the sort of cycle that you try to predict. Other forms that we've also explored is debt, which has many advantages. It's not dilutive in the same way. You still have to consider the interest payments, and it may come with some restrictive covenants, but it rolls over. You can roll it over and you can pay some back. You can take out additional loans, and it can almost become a limitless source. It can go on almost forever. The other form that we've also adopted has been more strategic collaborations, which overlaps with many of the considerations that Tracy's given, and we've raised over 500 million in the past over these types of deals with BMS and CSL Behring more recently. And typically think of that as on the enablement side. What does that do for each partner in terms of enabling the other party to either have access to a technology down to a straight licensing transaction, as we did with CSL Behring, because we didn't have the commercial infrastructure, and they're commercializing the Hemgenix, the hemophilia B product. Right. I mean, an additional sort of path we've gone down, which again is maybe more fortunate, and last year we sold the first tranche of the royalty rights of Hemgenix, and that raised over, well, close to 400 million. And that, when we look back now with where the sort of markets continued to go, we think was, with hindsight, a wise decision. There was a lot of discussion at the time whether it made sense. It gives uniQure a little bit more financial flexibility, but it does decrease, and investors aren't always so keen on that, because it does decrease the potential financial upside that could come. Mm-hmm. I mean, in terms of the second question, could you just repeat, please, Audrey?
Well, actually, I wanted to follow up on what you just said. So how do you go about making those decisions in terms of giving up the upside and de-risking the platform? Is it based on the equity environment, the market environment, investor sort of, I don't know, how do you attack that?
There's extensive discussions, as you can imagine, between the CEO, the CFO, and the board in particular around, and it really depends on the market conditions. I mean, I think if we were in a more bullish market, we would probably not have sold wouldn't have sold the royalty tranche. We would have perhaps raised another 100, 150 million on the market. That was and it depends on our runway to the next inflection point. How much do you need in order to keep the business stable? And, with other adjustments around how do you gate the projects in terms of, traditionally everybody's concerned about speed, but that, introduces more risk, it puts more capital at risk. And so all of those factors just play into what the right financing structure would be, and the opportunities that arise at the time. Of course, it's very opportunistic. If there's, we had a partnership with BMS on cardiovascular indications, where they had the therapeutic expertise, we had the gene therapy expertise, and that's what it could, it just made sense from a partnership perspective that way.
Yeah. And
so, no, please.
I was going to say, how much does the clinical stage of the asset, preclinical versus clinical, come into that equation in terms of looking from an asset perspective?
Well, it's more expensive when you're in the clinical stage, if that needs to be stated, and it starts to get real. So I think as having worked previously in more sort of the startup environments in the previous 2 or 3 companies, where it's all about the potential and the potential promise that's out there. When you start getting clinical and further down the clinical path, it gets much more real, and maybe some of these considerations that Tracy was alluding to in terms of valuations, start becoming much harder numbers, much easier to calculate, because you have actual clinical data and you can actually calculate the benefit. So that really depends on, and again, how promising it is. I mean, and the risk. So you never want to give away your crown jewels. So we have, our projects which are moving forward. We're very excited about them, but at the same time, we have to think, well, how much money do you start investing? Do you bet the bank on, you bet the company on one product, or do you think about maybe giving away a little bit to then help fund more behind and create a more sustainable business, but then you lose that moonshot potential. So that really depends on the asset, the environment with which you're in, and the data that's coming through.
Got it. Aaron, back to you real quick. I wanted to find out, let's talk about challenges a little bit. So how are you structuring deals? You're more in the pharma services space, I suppose, than the therapeutic space, so different perspective.
Yeah, and tools, life science tools.
Life science tools. Obviously, the risk return equation is very different, picks and shovels, so to speak, versus the binary risk associated with therapeutics. How do you look at the market in terms of risk reward? How do you structure deals in a way that helps you win? And what pockets of opportunity are you really seeing out there right now? And how does that structure interplay with those opportunities in terms of how the market moves?
Yeah, so I guess the fundamental question in all of those is risk return, and how do we kind of structure around that. I think for us, we, in our business, I mean, to have good outcomes, it's all about how you enter a business. It's all about how you manage and co-manage the company in partnership with the founder or whoever's leading it. And then it's all about how you exit it. And so those are three things that we think about a lot. With ARCHIMED, I think we've invested so heavily in our business and being supportive partners and being able to be partners for growth and creating value, that we have a little more flexibility on how we enter a company. So we tend to be quite reasonable on valuation up front. The other thing that we've done is invested heavily in building relationships with a lot of the strategic buyers in the universes that we invest in. I think what that allows for is earlier discussions, getting strategics warm with the business over time, because it's probably no surprise to anyone, but a strategic, when there's strategic value to an asset, they're going to pay more than any financial sponsor will down the road, which obviously benefits us and our partners and the founders, whoever rolls over with us. When it comes to thinking through risk and return and how we structure deals up front, again, we like when those who have built the companies are willing to take risks with us, right? Are willing to be partners, are willing to quote unquote roll over consideration from a transaction into the company moving forward. That allows us a couple things. It affords us, it shows a big commitment that you believe in what you're building. It shows that you believe in the price or the agreed upon liquidity event. It shows that it also gives us, to an extent, downside protection. There are also, when there are gaps in agreed upon valuation, there's different structures that we use to, quote unquote, bridge those valuation gaps creatively. We find ways to make sure that people are compensated, subject to us meeting a minimum return threshold that we need to achieve, quite frankly, to do our job, that you are compensated inordinately at the back end. There's ways for us to move consideration into debt post-close so that you're getting paid out interest and or amortizing a quote unquote a loan on the business that's cash that's directly paid out to you as kind of the former founder and owner. And again, I also alluded to us getting more flexible in situations where we are sometimes willing to take minority positions. A lot of times this tends to be for large capital equipment or facility builds, but we'll structure bonds or notes that can behave like equity in nature, in the sense that they may convert at a pre-agreed upon price. We'll do that sometimes when there's, again, a gap in valuation. We can't agree with the owners of the business about what the value of the business is today. We know the founders believe that the company is going to grow like this. In my experience, it often doesn't. And so, a lot of times it's hard for us to get comfortable with paying you with a number on a spreadsheet or a number you put on a PowerPoint presentation that's 2 years out. So we agree on a price that it could be, assuming you achieve certain milestones. Again, I think, my colleagues up here mentioned earnouts too, right? are different things that we can use to kind of bridge, quote unquote, the gap in valuation.
Very interesting. I hadn't heard some of those creative structures before. So everyone's talking about a word I hear often, dry powder. So talk to us about the bid-ask spreads that exist in the market, and you're obviously deploying tremendous amounts of capital, but have you seen a fall off in that? And do you see the drop in rates impacting the velocity at which you're deploying capital? And how do you see post-election, perhaps going into 2025, stay alive until 2025, I think was a common phrase, but what are you seeing in pharma services, tools, technologies, and do you imagine that pace of deal making increasing as we go into 25 and beyond?
Yeah, no, it's a lot of good questions. Well, I think first of all, when you hear the term dry powder, I think quite literally what that means is the amount of capital that is able to be deployed or spent into buyouts or growth investments. And right now, I mean, it continues to kind of break records, right? There have been, I guess the fundraising environment today is not as easy as it was 5 years ago, but there's still a record amount of capital out there. So, and obviously there's only a limited supply of companies or companies that, depending on how you structure and how you invest, right? If you're looking for equity or upside, you want to invest in companies that are winners or could be winners. If you're investing debt, it's kind of a different strategy. So dry powder is referring to quite literally just the amount of capital that's out there to be invested into, a certain set of companies. So I'd say in terms of that dynamic, I did mention earlier that it's more of a buyer's market than a seller's market right now. I do believe that, but there's also an ungodly amount of money out there for the right businesses. So, then it comes down to how do you present yourselves? What kind of metrics do you need to focus on building to actually attract those sources of capital? And that's probably a different discussion. I think the other two questions you had were about interest rates and then the election coming up. We could start with the election. I think, no surprise to anyone, it's been probably a chaotic political environment over the last decade here in the US. But what we're seeing, quite frankly, is a lot of founders who are contemplating selling their business and, rightfully so, focused on the tax impact of, a Trump versus Harris election. I think people tend to believe it's going to be a more favorable tax environment under Donald Trump than Kamala Harris. And I think, given where the polls stand today, it's actually causing some folks to consider pushing, transaction timelines forward to before year end.
That's interesting.
Yeah, as opposed to, following an election. There is some concern about a Kamala Harris election and the impact on taxes for those who are considering major liquidity events. And then interest rates, I mean, it's no surprise. I think the way interest rates have been trending has impacted the ability for folks to attract debt financing at rates that, are stomachable. So, the worse rates get, meaning the higher they go, generally speaking, you tend to see an impact on the M&A environment, M&A market, in terms of less of an appetite for larger valuations, larger deals, because a lot of times we do use us specifically, we tend to, again, be more focused on growth. When you take on a bunch of debt in a majority type transaction, there are covenants attached to it. There are stipulations that tend to restrict you from growing the business at your leisure. And so, we tend to shy away from that, but I can say the rest of, quote unquote, the growth equity, private equity market has definitely been impacted by rates, so.
Tracy, just shifting gears a bit, you have quite a background in legal and the perspective of how to mitigate risk perhaps and structure a deal in our complex gene therapy environment. So how would you share, or could you share an example of a financing structure that posed significant legal challenges perhaps, and how you navigated that to ensure success of the transaction.
Sure. And in my intro, I didn't introduce my legal side. I am a lawyer by training, M&A, and IPOs was my background before sort of going in-house and then switching towards the business side. I wanted people to listen to me first before just pegging me as a lawyer. And so, yes. So, I mean, I think some of these things are very obvious that we're thinking about. Where does the complexity come in when we're structuring deals? IP is tricky, depending on who you're doing the deal with. But if it's early stage companies, IP is tricky. Are we doing something as a co-development? If it's a straight acquisition, you know, other than diligence, it should be clear. But if people are doing, and I think in this environment, there are more flexible types of deals going on, whether they're co-cos or, you know, some other type of arrangement like that, options, collaborations, and we're seeing all these different words. I think the IP is tricky. It can be, and so how do you build that, but then also make sure you have sort of a parachute out if you need to separate things at the end. I'll also just say on the milestones that we were talking about before, I do think trying to structure them, no matter whether it's a license or an acquisition, but particularly with an acquisition, trying to structure them in a way and write them in a way that is so black and white so that it doesn't matter about the employees or the interpretation. You're working with somebody at that point, and putting people in that situation of deciding whether something's been achieved or not. You know, with a clinical, okay, it's fine, first patient dosed. With the manufacturing, okay, are we GMP approved or have we reached a net sales amount? But when you think about the early stuff, the technology platforms, things like that, how do you define something in a way that is more black and white than fuzzy? Did we create this novel capsid? Is it truly novel? What does it look like to be considered successful? I think that's where it really gets hairy to think things through. So, you know, those are the pieces I think about. I don't know if you have any comments on that.
I agree.
Perfect.
I think I mean, it's, again, when you look at these contracts, maybe 5 or longer years after they were drawn up, you always see faults. And, you know, often you're inheriting these and you look back and think, why did they do that? Or
Can you give us an example of one of those things?
Okay, well, one more recent one would be the, no, I can't. I'm not sure what's in
I
the
knew
public
it was
domain.
going there. You're publicly traded, right?
But I think the point I was trying to make on that, without maybe giving specific examples, are it's the context at the time, and when you look back, and having had a short span at Alliance Management, and you know, you spend a lot of time trying to understand why these points were put in different contracts. And I'm coming back to my Roche days or to now. It always I think pays to look back and say, well, what were they thinking at the time? Did we, you know, and you know, alluding to some recent considerations would be like, what were the launch projections or the approval projections? You know, why were they thinking they'd get the first commercial sale in Europe or, you know, the US, and how was that? What were they thinking? Because how you predict those things, often several years out, is really difficult. And I think that's what part of what you're alluding to in terms of the putting down on paper something that you're gonna be living with afterwards, and often it's difficult to then renegotiate those you know, economic terms, because you know, there's always going to be one party that potentially wins and another that's going to lose. So,
yeah, we had an interesting structure with our deal that played out at an interesting time in the market. So your agreed upon, let's say, option exercise price in 2019, and what those metrics are can change over time, particularly related to multiples and whatnot. So I understand what you're saying. Also, having lived through, worked in many industries outside of biotech, including real estate and utilities, and seen the ebbs and flows of the market, and the regulatory environment also plays a huge role in regulatory changes and its impact on deal structure. So it's interesting to pay attention to all of that. I guess I would just want to, we have about 20 minutes left. I do want to make maybe 10 minutes for audience questions. So in the last 10 minutes here, maybe just talk about, there's a lot of folks in the audience that maybe are looking to raise capital or perhaps exit a business or sell to big pharma or market to you. So like we have a lot of, there's a lot of preponderance of CDMOs in the market now. Maybe, Richard, you could talk about, because you mentioned the cost of manufacturing in CMC, talk a little bit about your manufacturing strategy, perhaps, and the cost of capital as it relates to facility build, and how you think about, from a planning perspective, CMC and cost of manufacturing in the life cycle of a drug.
Well, that's very topical. I'm not sure if you're referring to the fact that we did just divest our manufacturing facility. So, and I think it comes down to what's fit for purpose at the time. I mean, I know last year when we started some of these conversations, we have we built a commercial stage manufacturer because to get Hemogenics approved at the time, we didn't have a choice. I don't think we could have gone to a CDMO at that time. And so like many other companies in the field, we built our own. And then maybe the pipeline didn't come through to fill the capacity at the rate that was maybe planned 5, 7, 8 years earlier. And when we were considering the cost of the manufacturing, the ability to serve our own pipeline, but what the facility, we had untapped value in that facility, in that we were not running it at capacity. Right. And I mean, we recently divested it to Genesen, and we think this was a classic win-win, because we now have equity in Genesen, we have our CEOs on the board of Genesen, so we have a vested interest in the success, and we also have a partner on, right next door to where we are in Lexington, that is actually, where we have arrangements where they will be manufacturing, they continue to manufacture the commercial product for CSL, and they will continue to manufacture our GMP clinical stage assets that are now in clinical development. So they've hit the ground running with revenue. But they also have the opportunity to build out the business in a way that we would never do, because it's not our business model. I don't think we talked about could we go into the CDMO business, but I think that would just be a huge distraction from trying to do the therapeutic work, which was our core expertise. So this way, it unlocked value. We don't have the cost of running that facility anymore, so it saves us tens of millions of dollars per year that we can reinvest now in our early R&D activities to create value that way, while maintaining the relationship and access.
Yeah.
So, I mean, that was our experience.
Yeah, beautiful deal, I think, from all perspectives. So nicely done, and I'm jealous that we weren't involved. Aaron, you mentioned earlier KPIs that you're looking for, and maybe it's the topic for another time, but I do want to just double click on that, because it is super interesting to me, and I'm sure for others, to understand what you're looking for perhaps, and how someone would go about positioning themselves to get access.
Yeah, sure. I mean, look, for our strategy, we also realize the current market environment, right? It's there's a lot of people not performing to the expectations they had for themselves. But certainly, I think when you're looking at an attractive business, quote unquote, right? Obviously, a lot of it depends on the segment of the market you're in. I think this will go as no surprise, but recurring revenue is obviously an extremely attractive indicator. You have repeat business from your largest customers. I mean, your customers speak for themselves, and they'll speak better than anyone will ever do in any kind of diligence about the quality of the offering you provide. So, I mean, you know, some of the obvious ones that we look for, right, are growth, margin profile, how well or how efficient you manage your fixed cost base. I'd say the quality and experience of the team, and we look at that at all levels. Again, going through a process with us, I mean, it's not always fun for the time being because I liken it to more or less a colonoscopy for your business, but it's we do it with an intent of being a value-added partner.
Cologuard, by the way.
Yeah. We do it with the intent of being a value-added partner post-close, right? We have to understand your business as well as you do to be a thoughtful partner. But anyway, going back to the question, I mean, certainly the capital requirements that have been needed to grow the business, the ones that you expect moving forward. But I mean, for me, in my experience, the biggest indicator of success tends to be a repeat purchasing base of customers, at least in the markets that we focus in. So that's an area that we spend quite a bit of time. Risk to certain vendors, right? How vertically integrated is the business? I mean, we've definitely been caught with our pants down before on that issue where, you know, a key supplier goes out of business and the company's in you know, big trouble because they can't meet customer demands anymore. Customer concentration is a big one. It's, you know, somewhat obvious, but, you know, if you lose a key customer and they make up half your business, it's a pretty dramatic impact to a small company or a large company. But yeah, those are some of the high-level metrics. We obviously look at how you manage your business, right? What operating metrics do you track? How do you, depending on your size, it can be easier to manage a company day to day if you're 10 to 15 employees. But you know, if you're hundreds to thousands, how are you actually at scale managing that? So it's pretty in detail.
Very good. That's very helpful. Thank you so much. So in the last couple minutes here before our audience Q&A, can you each take a minute to talk about lessons learned perhaps and how you're using those to position yourself for future success? Maybe give an anecdote about, I don't know if mistake is a good word, but maybe a stumbling block that you had and something you've learned from that. Tracy, you want to go?
You know, I think thinking through, again, what you were asking me to do was thinking through deals. Not having a crystal ball is really tough.
You find one, I'll take it.
Yeah, exactly. Again, I think it's trying, there's so much complexity, and as you look back, you never get things right, but did you get enough right? And I think truly is the relationship good enough that when you hit those things or when something doesn't go exactly right, do you have the relationship and the trust built to get through it? I do think something that's really interesting, maybe not so much a mistake, but something's interesting from a perspective as you move from, you know, early technology to preclinical to clinical, sort of the cost of financing and thinking that through. So as a preclinical company, it's like, I'll give you 1% royalty to get this 500K because that's going to get me to IND. But then as you're moving forward, and you're looking at your stack and you're thinking through to commercialization and how am I going to make this product viable? Some of the decisions in the early days, the cost of capital is so much higher than where you are now. And so I do think going through the life cycle of a company, thinking through the true cost of that capital and what it makes sense. It might make sense to buy some of those things out that, you know, to get rid of some of the stack later on. But in gene therapy, I think we have to be really conscious about costs, particularly at the commercial end. And so that's sort of one thing that I've learned.
Very interesting. Cost of capital over time and dilution to the cap stack is interesting, and it's an important thing to keep in mind as companies are making their way through their life cycles.
Yeah.
Yeah, I'd say for me, it's respect for the entrepreneur. I think a lot of times, if you're in the position of investing, a lot of folks in our industry haven't actually gone and done the hard work of building a business. I've tried. I'm a failed entrepreneur. I'll proudly admit it.
Congratulations.
It's the hardest thing I've ever done, but it was, it was the best failure I've ever had because it allowed me to appreciate the hard work that's done by a lot of times the folks on the other side of the table. So, when we invest in your business and give you our capital, whether you're taking it off the table in a secondary or it's primary for growth, you become the manager of that capital, and every dollar you spend is an investment that you're making, right? So, I mean, at the end of the day, our bet is about betting on the right capital allocators as well. So I think what I've appreciated over time is the importance of really assessing who you're backing. It's not necessarily the strategy, the business model, that all matters, of course. But at the end of the day, if you're backing the right person and the right team, they adapt and they'll figure out. The chaos of the market that we've all seen over the last couple of years is you tend to find the folks that are most creative and adaptable are the ones that win. And so we spend a lot of time thinking about that. At least I do. I've learned the hard way myself. So
Being nimble and definitely pivoting as the market changes. We saw that definitely in COVID as well. A lot of pivoting was so important. Richard, do you want to give your thoughts on lessons?
Yeah, I think maybe taking a slightly different angle, not to be repetitive, would be, in the R&D cycle, we always plan for success. So, and I think that's important because you need to be prepared. But in our business, I think if something can go wrong, it will go wrong. And you can't always plan for that, but you can start putting in mitigations and at least be open to those. Use the word pivot or change of direction based on data. I mean, we were starting a gene therapy company. We were contracting with a large CDMO. This was before uniQure, and then COVID hit. And we were up against, the U.S. government can requisition all the raw materials and starting requirements because it's very similar for vaccine production. And so how you plan and how you start, planning, you plan for success, but you mitigate for failure or for, bumps in the road, I think is something that almost requires as much time in the discussion so that when that happens, you can move quickly.
Yeah.
Well said. Thank you all so much. Do we have any questions from the audience?
Can you hear me?
Yes.
Fantastic.
Oh, look, there's a mic.
Great. So this is one that sort of links strategy, investment, and downstream returns. So Blue Rock was formed early, and then was partially and then fully acquired by Bayer. And they're developing, as everyone knows, a embryonic stem cell therapy for Parkinson's, and just recently had released their 24-month data on their 12 patients. In the interest of disclosure, I was one of the co-founders of Brain Neurotherapy Bio, that is now part of the AskBio, and now part of the Blue Rock enterprise. The convergence in the same indication with two advanced and admittedly very promising therapeutics still in development raises this question about strategy. So maybe this rolls up to Bayer. But as you were negotiating that deal, and Sheila and others, and I'm sure Jude was involved, when you think about these points of convergence, they have profound implications, not only for which program gets advanced and maybe registered if the pivotal trials demonstrate clinical endpoints met, but it has implications for the founders and everyone else who is looking to see where these therapies are going, as they may have a favorite. Cell and gene means cell therapy and or gene therapy. So I thought I'd just throw that out there. I know it was probably not on the horizon. B&B was formed in 2018. The transaction you mentioned, Tracy, I think was in 2020, if I recall correctly. So maybe you could comment on it. All of you may have an opinion, because this is often what me, a co-founder, former CEO times several, always think about, but we don't get the time horizon as right as we'd like to.
Sure. So I think, thank you for that question. Yes, and I think so. If we look at Bayer, when they were, and I was not at Bayer as a part of this decision process or any of it, but as they were looking at their strategy, as you very aptly put, what were they looking to do? Well, they were looking to move from small molecule and to become a more innovative pharma company, and that doesn't come from within. That comes from outside in most cases. And so, they did at that time look at cell therapy, gene therapy, and actually they have another sort of satellite company, Vividian, which is early stage focused on oncology. And really, to your question, I think your question is really, what happens if you're covering the same indication with different modalities? And I think if you look at these points, Blue Rock was extremely early stage when it was going through. AskBio was earlier, but probably a little further from a clinical perspective, and Vividian, even though it's early as well. And so, as you look, I think from a strategy perspective, and I don't really want to speak on behalf of Bayer's strategy team on that, get myself in trouble, but you need a lot of shots on goals. These are Parkinson's disease, for example, is a huge disease with a huge population, and there are subpopulations within it. And so having different approaches, cell therapy, gene therapy, other ones. I mean, we look at that with other large indications in the market. We look at Alzheimer's. How many times have people tried so many different ways to make some sort of improvement, and where are we after decades on it? And so I actually think it's a really good strategy to have a lot of different ways to attack a problem, particularly when it's a big one like that. And so what are we doing at AskBio with our Parkinson's? We just announced this year that we're moving into phase 2. That's a big trial. And it's a global trial, and it's really exciting to be moving forward and hoping to find something. We are moving fast, and Blue Rock is as well. And so we're cheering for everyone that we have as many solutions for these patients as we can have. I don't know.
The point here is that they're identical clinical indications. The inclusion criteria for both are so fully overlapping. So we think about it, and I'm the co-founder, chief medical officer of Blue Rock's competitor, Kenai. We think about this space just as you were elaborating, but it's idiopathic PD. And the inclusion criteria for phase 2A would be, as you said, global. And as well, from what I understand from what Blue Rock is doing, similarly, the inclusion criteria, and they can. So this is the last point. I speak to patients all the time, and they're going to go with their feet, but the referring neurologists are going to probably be influential in deciding which therapeutic, whether it's during phase 2A or whether it's a registrational study. And from my perspective, as I think about positioning us, my company, I think about this all the time because we don't want to be directly in the same identical clinical space. We want to think about broadening so more patients would be eligible.
All very good points. And I do see an interesting, perhaps, shift in our market from physician-controlled to direct-to-patient, and how that's going to impact, particularly with patient advocacy organizations. And so let's see what happens over the next 5 years, and we've seen it happen in the GLP-1 space, so maybe cell and gene will be next. Any other questions from the audience in our last minute and a half here? Avi, ask a question. All right. Oh, we've got one over there.
Hi. So I've spoken to quite a few people, and the sentiment is pretty positive about the future of cell and gene, and this is more towards Aaron, but the only real negative sentiment I've gotten are from early stage therapeutic developers and technology platforms saying there's not enough early stage funding, and then that can have downstream effects for innovation in the next 2 to 5 years. So what would you say to those individuals that have pretty negative outlooks for early stage funding? What do they need to do or what do we need to do to kind of bring that back in?
Sure. Look, it's a great point. And again, I'm speaking from the perspective of what we're seeing in the tools and services market, and certainly it's not lost on anyone that there's a lag probably between what's going on in the drug development world versus how that capital eventually flows through to the picks and shovels and service providers. But I'd say there is certainly some optimism, right? There's an expectation. Pipelines are growing. We're seeing it across our portfolio companies. People are expecting a much more positive 2025. But I'd say, when you're looking at the tools and services market, it's not what it was 2 to 3 years ago, right? But what I would say, I guess, to quote unquote the naysayers, we are still very bullish on the outlook of the market. We realize that we try and take a longer term perspective in how we think about these things. And I don't claim to have been doing this as long as some of you in the room, but I've been around the block enough to know that the market goes through cycles, and I think this is a cycle unlike any other. So we remain bullish as a firm about the outlook for the cell and gene therapy space, which is why I'm here, quite frankly. And I also think it's a good time to invest in it because I think valuation expectations have been tempered a bit. I don't know if that answers your question, but maybe just a perspective from the areas or the pockets of the market that we spend our time in.
I'm sorry to say we're out of time, but thank you all for coming to join us, and thank my panelists for providing their perspective. I hope that this means with the coming election perhaps and lowering of rates that we'll see a lot more activity and valuation adjustment. So thank you all and enjoy the rest of the show.